Hey guys, welcome back to this channel. In this video, I'm gonna share with you how the typical stock market behaves and how you can use that to your advantage to buy low and sell high and not get caught in any value or FOMO traps. So, if you have been looking around the stock market, then you must have heard of people saying buy low, sell high, invest for the long term, don't buy into stocks and get caught into the FOMO trap. Which all of that are true, but that's not everything that makes up the stock market. If it were that easy, then everyone will be rich and there will be no poor people, right? See, the stock market, if I were to put it in simple terms, is made up of two halves. One half of it consists of money, the company's financial, the fundamentals of the company, the business model, the company's earnings and profitability, and yada yada yada. But do you know the other half of the stock market is actually dictated by human psychology? See, in life, time is what everybody has and share in common. But it's safe to say that not everyone value time equally. There are people that are more eager to achieve more success and gain more profits within a short period of time, hence short-term traders. And on the other hand, there are also people that are able to take things slow and steadily, hence long-term investors. So when these two types of people meet together in the stock market, there will be some sort of mismatch, just like pizza and pineapples, which results in a difference in the supply and also demand, and hence the rise and drop of the share price. So to better explain this, let me show you the illustration of the typical stock market psychological cycle. We start from the left to the right, and at stage 1, this is what we call the speculation phase. This is when a stock is discovered and introduced to the stock market for its potential and how promising it can be, delivering great business model or achieving higher and higher quarterly profits, which on paper seems like a good and profitable investment opportunity. This trend continues up to stage 2, what we call the peak optimism phase. This is when the excitement peaks. People are starting to jump into this stock because its share price has been increasing tremendously. More and more good news are starting to pop out. Some of the promises are being delivered and the company has increased its net profit quarter by quarter. So on hindsight, this is when people think that its share price is going to the moon or it's going to skyrocket, so people are just riding on the FOMO train and jumping into this stock. But as you all know, good things don't last. What comes up must come down. Whatever hype that is built in this stage 2 will at some point prove to be insurmountable to the public's expectation. And that leads us to stage number 3, which is the bubble pop phase. This is when the bubble pops. The market has assigned such crazy valuation to this particular company. So literally any small or slight bad news, for example business disruption due to the pandemic, or there is a shortage of supply, or if there is any election in the particular country, or the quarterly profit did not meet up to its crazy expectation, and etc. And this is when many initial investors will start to take profit because they are uncertain of what will be happening in the coming days, and this is exactly the time when the fear and also the anxiety starts to build up. So retail investors like me and you need to understand this. Institutional funds will always be faster than us regardless, because they have better market intelligence as well as network. So if there's any upcoming negative news for this company, then as you can guess, the institutional funds will be the first one to sell off their positions, and what follows will be history. The share price will decrease 3% a day, 5% a day, and this is when a lot of people are contemplating whether or not to sell this stock because they are stuck at the peak of the share price. There will also be another group of people that are living in denial and does not want to cut their losses, and this is where a lot of people start to convert to call themselves the long-term investors because they have no option but to wait up for the share price to rise again. Which, don't get me wrong, long-term investing is a very good mindset for most of the people out there. But you gotta be honest and ask yourself, is the company that you are investing into a good or financially stable company that has great fundamentals and potentials to come back. If this company has great fundamentals and the business model has not changed a little bit, then smart and savvy investors like you should consider buying more to average down your costs. A long-term investor will always enjoy this kind of sales and treat it as a discount to buy company at a cheaper valuation. So why not buy more of this company if it's a great company? But for some reason you have bought into this bad company in search for short-term profits, then you gotta ask yourself and think again. Sometimes it's better to just cut your losses and look for better opportunities elsewhere. So at this point, regardless of good or bad company, if the negative environment persists, then that will lead us to stage number 4, which I call it the valley. And at this point, negativity is running rampantly. There will be tons of negative news clouding this company. Some will say that it will not last through with its cash reserves. Some will say that this is a sunset industry company, or some will think that this company has no short-term catalyst that will bring them out of this negative environment. So this is the best time for you to do your analysis whether or not this company is worth buying into. Should you put your money into this stock? See, sometimes there are factual reasons that tells you why this company has reached this phase, and very likely something catastrophic has struck this company, which could or could not be within this company's control. Again, we come back to the same question: is the fundamentals of this company intact? Can the cash reserves of this company last it through this tough time? Is the business model attractive and you like this company moving forward? If the answer is yes, then by all means, this is the best time for you to buy in. If the answer is no, move on. Either cut your loss or just look at other stocks, because there will always be better opportunities elsewhere. So as you can guess, good companies, they usually are able to last through this tough period, which leads us to stage number 5, which is the comeback. The comeback phase is usually accompanied by good news or positive news that there is hope in this company, whether be it in the form of new or updated business model, new management's vision, new financing or partnership deals obtained, improving quarterly profits, new invention, or whatever they may be. And this is when the stock makes a comeback because the public is being optimistic about its future. And if there are some promises or goals being delivered, then rest assured the share price will follow suit and increase itself. And as you can guess, we are all back into stage 1, where there will be mix of speculation, good news, and also faith in the company. This entire cycle will repeat itself indefinitely, whether be it for any stocks from any stock market, because this is the typical stock market psychological cycle. So if you want to be a smart, savvy, and well-informed investor, you should always take into account all the possible factors that will come into play. Before you invest your hard-earned money into any stocks, remember these 3 thumb rules. 1. If it's too overvalued, then chances are the upside will be very limited, because most of the time you only realize it when it is too late. Remember this, the stock market will never wait for you. There will always be people faster than you, be it in obtaining information or making investing decisions. Number 2. If it's too good to be true, then think again. Any business in this world will always have a loophole to be disrupted. So don't think that any company will be immortal and be growing year after year. You need to do your research and take into account all of the factors that will come into play, be it macroeconomics, the industry's growth, management's vision, and etc. Number 3, if the risk is too high, then think again. Are you able to sleep through the volatility? A trending stock will always be filled with hype, and in result there will be a lot of trading and transaction volume. So its share price will be a roller coaster ride for any investors that want to take a position in it. Of course, at the end of the day, it is your money, so invest it safely according to your personal risk appetite. So yeah, that is all for today's video. If you have gained some value, help me smash the like and also subscribe button down below, and it will help a long way with this YouTube channel. Thank you very much for watching. I really appreciate it, and as usual, I will see you in the next one.